This information was compiled for the IRS Reddit community and anyone interested in how wealthy individuals and corporations exploit equipment and luxury deductions. Equipment deductions can be a powerful tax strategy if you are an individual or operation looking to deduct taxes using Section 179 to write off expensive luxury vehicles. Various classes of taxpayers use Section 179 to write off reasonable business expenses. When wealthy individuals and asset-rich operations under a corporate umbrella apply these rules, the lavish personal perks and benefits far outweigh those of most organizations and small business owners that use them. What is Section 179? Section 179 helps businesses of all sizes afford the cost of big asset purchases. With Section 179, companies can deduct the total cost of capital expenditures immediately rather than recovering those costs over the life of the assets or with depreciation over time. Spreading the expense deduction over multiple years can be a good strategy for some. But for many businesses, Section 179 is essential to afford new assets and drive production, investment, commerce, and ideas. For others, Section 179 helps exploit their taxable income. Section 179 can reduce taxable income to zero. Bonus depreciation, when you buy new, can exceed taxable income and generate a net operating loss, reducing taxable income further into future years. What vehicles qualify for Section 179? In short, all of them. If you purchase any vehicle to use in your business, you can use Section 179 to deduct the full cost of that vehicle in the first year, and there are only 3 limitations. All equipment under Section 179 must be used for business at least half the time. If the business use percentage is more than 50% but less than 100%, Section 179 deduction will be prorated to reflect that business use percentage. First-year deduction limit for small and heavy vehicles. If equipment is placed in service, whether new or used, it must simply be new to you. Section 179 also allows deductions on vehicle and equipment financing as long as 1. Your business use percentage is at least 50% and 2. You place the vehicle in service that year. Doing so allows you to deduct the cost of an asset that you haven't yet paid for. This can help reduce current year taxes, boost cash reserves, and improve cash flow. Leased vehicle expenses are also considered deductible under Section 179 as long as the agreement made is a standardized capital agreement, meaning that the lessee retains ownership of the asset. As you realize how much Section 179 encompasses, we'll only begin to unpeel how industrious, wealthy, ultra-rich individuals and organizations can play with scale, size, mass, and financial momentum. Clear examples of luxury deductions unavailable to most are yachts or seaboard pleasure craft. The benefits are numerous, and these deductions depend on how the vessel is loosely utilized. On top of standard equipment deductions allowable under Section 179, there are some substantial tax deductions if using the yacht is for a legitimate business purpose, such as chartering, sightseeing tours, or a meeting in Malta in 3 weeks. To qualify, the yacht must be used at least 50% of the time for business purposes, and how business is defined is very loose. Other deductible business expenses include equipment, slip costs, fuel, maintenance, crew salaries, interest, property tax, insurance, depreciation, home office deduction, and the business tax deduction. And some wealthy individuals live on their yachts, and there are tax advantages to using a yacht as a primary residence or a second home. In this case, the boat loan interest is also tax deductible. The vessel must have a toilet, cooking facilities, and a sleeping area to qualify.